In this video, I want to make you aware of an ETF that was launched about 10 months ago in April 2025 and has delivered an 83% return in just 10 months. Again, 83% return in just 10 months. What makes this ETF so fascinating is not only its strategy, but the results it has already produced in an extremely short period of time. If you had invested $10,000 at launch and simply reinvested all the dividends along the way, that investment today would be worth approximately $18,300. Yes, you heard that right. That is a whopping 83% return in less than a year. Now, let that sink in for a moment. If this pace were to continue, that performance would extrapolate to roughly 104% in a single year. In simple terms, a $10,000 investment could grow into more than $20,400 in just 12 months. That is the kind of the growth most investors expect only over several years, not within one. So what exactly is driving this kind of performance? One of its most distinctive features is that it aims to distribute income on a weekly basis. Yes, weekly income, not monthly and not quarterly. Before I go any further, I want to quickly mention that I have already made videos on two other new growth ETFs with similar high potential strategies. The links to both of those videos are in the description below. On this channel, I consistently review new ETFs with massive potential and break them down in a simple and practical way. If this kind of content interests you, make sure to subscribe so you don't miss future ETF ideas with strong upside. Now let us talk about the income itself. Before this is where things get really interesting. This ETF has paid a dividend every single week since the second week of April 2025 all the way through the recording of this video without missing even 1 week. The very first payout was on April 21, 2025 and the most recent payout at the time of recording this video was on February 5, 2026. Each weekly payout has generally ranged between 30 and 50 cents per share. When you add all of those distributions together, the total dividend paid over the last 10 months comes out to $18.24 per share, resulting in a dividend yield of approximately 30.47%. That number is extraordinary. As of now, there are very few, if any, ETFs offering a yield anywhere close to this level. And what makes it even more impressive is that this income is happening alongside meaningful price appreciation. In addition to the income, the ETF has experienced approximately 27% price appreciation since launch. At inception, one share was priced at $47.44. Today, that same share is trading around $60.1. Now let's take a step back and clearly understand how this ETF operates. This is an actively managed ETF that seeks to generate current income and capital appreciation through investments in a portfolio of roughly 15 to 30 publicly traded semiconductor companies. The fund primarily generates income by selling options contracts on its portfolio holdings with the objective of distributing that income on a weekly basis. At the same time, the fund seeks capital appreciation through its direct equity investments in semiconductor companies. The advisor evaluates potential holdings based on factors such as stock liquidity, options liquidity, price levels, and implied volatility. The portfolio is reviewed regularly, and positions may be added or removed as market conditions change. It is important to understand that the fund's primary investment objective is current income. Its secondary object is capital appreciation. Distributions are not guaranteed and may vary over time, depending on market conditions and volatility. Now that you understand the strategy, the income structure, and the performance, it is time to reveal the ETF. The ETF I'm talking about is the YieldMax Semiconductor Portfolio Option Income ETF, ticker symbol CHPY. The expense ratio for this ETF is 1.03%, which reflects the active management and options-based strategy it employs. As of the recording of this video, the top 10 holdings in CHPY include NVIDIA, Broadcom, Lam Research, ASML Holding, KLA Corporation, Taiwan Semiconductor Manufacturing Company, ACM Research, Micron Technology, ON Semiconductor Corporation. CHPY combines aggressive income generation with exposure to some of the most important companies driving the global semiconductor industry. It is not a low risk or traditional ETF, but for investors who understand the strategy and the risks. It represents one of the most unique income-focused ETFs currently available in the market. Before anyone gets carried away by the numbers, it is extremely important to talk about the risks, because this ETF is not risk-free, and it is definitely not for everyone. First, this is a high-yield options-based ETF, which means the income is not guaranteed. The weekly payouts come largely from options premiums, not traditional dividends. If market volatility drops, or if conditions in the semiconductor sector change, those weekly distributions can decrease, sometimes very quickly. Second, this ETF sells call options as part of its strategy. That means during strong rallies, especially when semiconductor stocks move sharply higher, the upside can be partially capped. You are effectively trading some growth potential in exchange for consistent income. Third, this ETF is highly concentrated in the semiconductor sector. Semiconductors are powerful, but they are also cyclical and volatile. If demand weakens, if evaluations compress, or if there is a broader tech sell-off, the ETF's price can decline significantly, even while it continues paying income. Fourth, options income does not protect you in a market downturn. If the underlying semiconductor stocks fall sharply, the ETF's net asset value can fall as well, and at the same time, distributions may also be reduced. And finally, this ETF has a short track record and a relatively high expense ratio of 1.03%. That means it has not yet been tested through a full market cycle, and performance will depend heavily on how well the strategy adapts over time. Now, let me be very clear about what I am personally doing. Yes, I have invested in this ETF, but I am being very careful. I'm not going all in. I am gradually adding, observing how the weekly income behaves, how the price reacts during market pullbacks, and how distributions adjust over time. I fully understand the associated risks, and this is why this ETF is only a small income layer in my overall portfolio. It is not a core holding for me. It is not something that I'm betting my future on. It is a tactical position designed to generate cash flow while I closely monitor performance and risk. If conditions change, or if the risk-reward balance no longer makes sense, I'm prepared to adjust or exit. That mindset is critical when dealing with high-yield and options-based strategies. The key takeaway here is simple. This ETF can be powerful when used correctly, but dangerous when misunderstood. Position sizing, discipline, and ongoing evaluation matter far more than chasing yield. Before I wrap this up, a quick and important disclaimer. This video is for educational purposes only. Nothing in this video should be considered financial advice or a recommendation to buy or sell any security. If this video helped you understand this ETF better, or if it made you think differently about income strategies, I would really appreciate it if you hit the like button. It helps the video reach more people who are looking for clear, no-nonsense ETF analysis. I would also love to hear your thoughts. Drop a comment below and let me know what you think about high-income ETFs like this one. Are you comfortable with the risk, or do you prefer more traditional strategies? I read and respond to as many comments as possible. If you want more deep dives into new ETFs, income strategies, and high-potential investments, make sure you subscribe to the channel. This is exactly the kind of content I focus on, and you do not want to miss the next one. Thank you for watching. I truly appreciate your support, and I will see you in the next video.